Welcome to the September video of the Beginner's Guide to Algo Trading with PineScript series. So one thing to keep in mind, if you haven't seen the video earlier in the series on understanding market edges, I highly recommend that you watch that because it describes the two main kinds of edges in the market and also the edge development process that we typically follow. What we added at the end of last month was an additional addendum to step 2, which is verifying the edge, and that's 2.3, where we added the Monte Carlo simulation, which is one of the most important concepts to understand, and it's a good way to predict future performance, assuming that the edge still exists. So definitely see that video on Monte Carlo simulation if you have not already. So today we are going to be talking about indicators, in particular an oscillator called the ultimate oscillator. It's a mean reversion indicator. And so there is some overlap between today's strategy and the strategy that we developed in March. Previously in this series, I did talk about indicators and how to evaluate them and how to evaluate strategy parameters in general. But today we're going to touch a little bit more on that with a concrete example. So indicators, do they work? Some people make a blanket claim that they don't work. And as you might expect, it's more nuanced. It's sort of like the blanket claim that all edges erode with time. The answer to that is also nuanced. And if you haven't already seen the video on understanding market edges or what exactly a market edge is, I definitely recommend watching that one so that you can understand my answer to that and why not all edges erode with time. So let's talk about indicators and markets. So most indicators are developed with a specific market in mind. So if you are using an indicator that doesn't match the general behavior of the market, which by the way, that general behavior can change for that particular market. But if you try to use an indicator that isn't aligned with the behavior of that market, then you typically will not have good results. So as an example, US equities tend to trend up. They tend to be long biased in the long term. But in the short term, there's a lot of mean reversion. And so oscillators like the RSI, stochastic, and what we're going to see today, the ultimate oscillator, are very good for finding long entries because they're good at catching pullbacks in an otherwise long-term bull trend. On the other hand, commodities tend to move in seasonal patterns, and this is because those commodities have suppliers and buyers, so there's actual consumers. So US equities tend to be more forecast based, so they price in future expected returns, performance of the company, and just general I touched about this in the first video in this series, so if you want to know why US equities tend to trend up, please go see that video. Commodities are a little bit different in that there is a supply phase. So let's take orange juice, for example. 98% of frozen orange juice is developed in Florida. And so there's a growing season, and that kind of determines the supply. And then the consumption of orange juice, which tends to be it tends to vary a little bit from year to year, but there is a consumption pattern, and sometimes it's under target, sometimes it's above target. That is the essentially the buyers. And so what you have there is that many commodities tend to be in a range for a while, and then they have a breakout and then a trend based on information. So using frozen orange juice as an example, let's say that there is a typhoon or some sort of bad weather expected for that particular year that may cause the growth or the growing of that orange juice to not be good that year. And so what you'll see is that orange juice might go sideways. And then once we know whether there is a harvest that has been successful or not, whether those crops got damaged or not, then we typically see that breakout into a trend up or a trend down just based on how that season went. And then once you get to the consumption season, that trend also tends to go up or down, or rather it goes sideways. Once we start seeing numbers on consumption, then it can go up or down. And so there's more cyclical movements in commodities where there's just seasonal patterns where they just go sideways, waiting on some sort of news that a lot of insiders don't even know, simply because you can't predict the weather, or rather you can, but you may not know for sure whether the orange juice crops are going to get destroyed or not. And then once those insiders are like, oh yes, okay, we've been confirmed that there's a good growing season this year, then they will buy in. They'll take the trend up, and then that's why breakout entries tend to work really good on certain commodities. And so because of that, you have to use, if you're going to use indicators to trade these, you have to make sure the indicator matches the behavior of that market. So one thing to watch out for is that there's a lot of marketing around indicators, just because what people will like to do is they'll build an indicator that measures something obscure. They don't tell you the formula behind the indicator or why it works. And of course, in the marketing, they will show you examples of where the indicator has worked while hiding all the examples and periods where it didn't work. And so you'll see a lot of marketing like this where you just buy this indicator. For $50, you get lifetime access. It's the one trade for life. It works on all markets. It's all you ever need, and it's hilarious because it doesn't work. So definitely, definitely avoid any sort of marketing like this. And by the way, I have this was free at one point. I'm not going to specifically reference which indicator this is, but this was free at one point. And I joined that Discord, and then I saw so many instances of people saying, "Hey, why didn't it work?" And ultimately, the author's answer was, "You didn't account for this," or you essentially some variation of you use the indicator right, but in the wrong setting, or use the indicator wrong, or otherwise blaming you for not being successful with this indicator that clearly doesn't work. So one of the other challenges with indicators is that some of them were developed a long time ago. And so those default recommended parameters, they just don't hold up. So one way that we can update them is to use the optimizer, which essentially says, okay, what would have been the most optimal settings to use for, say, the past 5 years, or the past 10 years? That's a way that you can get those parameters up to date. The problem is that the optimizer is one of the biggest traps in trading software, because what you'll do is you'll hit optimize and it'll find the best value. And depending on the indicator and what you're looking at, it might produce something like this, which is just insane. There's like almost no drawdown. It's just constantly making new equity highs, which is what all those little green dots are. And so if the equity curve looks unrealistic, if there aren't if there aren't drawdowns, if it just looks like this perfect strategy that's almost a straight line from the bottom left all the way to the top right corner, then it's probably unrealistic. Now, you can have linear growth where it's kind of a curve, but if it's just a straight line, that usually does not happen in real life. So what is the best way to use an optimizer to update an old indicator, but still evaluate whether it is an effective indicator and that we didn't just magically pick numbers that would have worked in the past? So this is something I talked about earlier in this series, but this is a good opportunity to show you an actual example. So what I'm showing here, this is the ultimate oscillator, has 3 parameters. The first one is it's like a daily parameter, and then a weekly, and I think a monthly parameter. But essentially, the example I gave above here is that if you have a strategy where the 5 EMA crosses the 20 and you buy, and then let's say you sell when the 5 EMA crosses back below the 20, what you can do is you can check similar values. So if you have a 6 EMA crossing a 21, you should get similar results. It probably won't be as good, or could possibly be even better, but essentially you're looking for that entire period of similar ranges to be stable, meaning have similar results. And so here you can see with the ultimate oscillator, this strategy of this is essentially what we're developing this month today in this video, is using all sorts of optimized parameters. Can you develop a strategy with the ultimate oscillator where it buys when it's oversold? So most oscillators have a oversold and overbought threshold. By default, the oversold threshold in the ultimate oscillator is below 30. So if we were to buy every time that the ultimate oscillator was below 30, and then we always sold using one of my favorite exit conditions, which is when the market closes higher than the prior day's high, what would our results be? And so you can see here, all of them have positive results. All of them have a strong profit factor. The thing that I don't like is the number of trades in a lot of these. So you'll see that the highest profit factor is a set of settings that only have 42 trades. And to me, that is not statistically significant. I like to see a lot more. And so the settings that I actually use when using the Ultimate Oscillator is the one in the middle, that 4, 8, and 10, the one that has 147 trades. So you'll see here the profit factor is still good, not as good as the one at the top with only 42 trades. But what you see is that this has the most trades in optimization. So it's most likely to be arguably the most stable, just because it's held up for more trades than the others. And so therefore, that's the one I'm going to use, even though some of the other ones might have a slightly higher profit factor. And that's just because I think if you have a threshold for a profit factor you're looking for and you're above it, and then you have a drawdown for a threshold that you're looking for, let's say it's like, I don't know, 15%, and you're below it, then what you want to look for next is what is the most reliable version of this strategy. And the most reliable is probably going to be the one with the most trades in historical backtests, because that means that it had the most number of temps that still met your parameters. And so for that reason, I am choosing 4, 8, and 10. So what is the Ultimate Oscillator exactly? Well, it was developed by Larry Williams, who is one of the most famous traders of all time. He won the World Cup Futures Trading Championship with something around over 1,000 plus return, which has not been matched ever since the inception of that tournament. And so what he wanted to do was develop an oscillator that looks at 3 different time frames. He believed that the problem with oscillators is that, firstly, he believed that an oscillator that looked only at one time frame was missing key data. And so since oscillators are best used for catching mean reversion entries, you have to, by that definition, you probably want something that is looking at some sort of long-term trend. So on SPY, we have the benefit of being long biased just by definition of so many things. Again, see the first video in this series if you want to know why SPY is long biased. So we arguably don't even need those additional time frames. But if you were to use an oscillator on some other market, like a currency market, that tends to trend in the long term and not necessarily up, but tends to trend in a direction, whether up or down for a long period of time before going sideways and then switching, you probably need to be looking at what is the long-term trend. And that's where a multi-time frame oscillator like the Ultimate Oscillator comes into play. So in particular, this one looks at 3 time frames, which Larry Williams believed would increase the reliability rather than just looking at 2. Use a 3rd time frame that's kind of in the middle in order to filter out even more entries. And so as a result, you end up with this 3 time frame oscillator, which historically has been very good for me on SPY. I haven't used it much on other markets, and I have multiple reasons for why, but one of the biggest ones is I just don't trade currencies, at least not right now as at the time of this video. And so there may be a day where I do decide to trade Forex, and I will probably use something like the Ultimate Oscillator, or at least test it and analyze it and see if it's good. But in theory, it should be good for any market that tends to trend in a direction for a while and then maybe go sideways and possibly continue the trend again or just flip direction, that sort of thing. So for this month's strategy, that last line there, I mentioned we're going to use the parameters that yielded the most trades in the backtest. And of course, we're going to, outside of modifying those 3 time frame parameters, we're simply going to maintain that same oversold entry. So if the Ultimate Oscillator is less than 30, then we're going to go long. And so that's what this looks like, is we simply enter long when the Ultimate Oscillator is less than 30, and then we exit on a day where the market's about to close higher than the prior day's high. And this is that back test. You can see that since the inception of SPY, there's 169 trades, which isn't a lot given the roughly 30 plus years of history. but you'll notice that the profit factor is very strong, and it's also an 80 plus win rate strategy. So honestly, just very good to include in your portfolio. And this approach can be used to analyze other indicators as well. But if you're going to test other indicators, and I absolutely recommend that you do, just test everything. Don't take things for their word or their marketing. Always test, verify, back, and analyze. You first want to make sure that the indicator fits the market that you're trying to test it for. So try to understand what exactly the indicator is doing. Ask how does that market behave, and if they don't align, you probably shouldn't be testing that indicator on it. If they do, then you probably have a decent candidate for testing on that market. And then the second thing is you probably want to update the parameters that puts an old indicator, and then you want to look at similar values. So once it finds the optimization result, look at the three values above it and three values below it, or roughly around that range, and see if you have a stable set of returns as well as stable set of drawdowns. And if you do, then you can probably say, okay, this is worth running, or at least considering. Whereas what you'll find with a lot of indicators is that they actually don't. There tends to be some wild fluctuations depending on the indicator and what exactly the indicator is measuring for. And that's how you know that the indicator itself might be flawed and not worth using. But the ultimate oscillator was developed by one of the best traders to ever exist. So naturally, as you expect, it's pretty good. And one thing that you'll notice is a lot of the top traders, they do make their own indicators, at least the ones that have been around for decades. So it's not surprising that the ultimate oscillator works. And in terms of coding the video for this month, I'm not going to record a video coding it. It's just the default settings of the ultimate oscillator, except we're using 4, 8, and 10 for the 3 time frames rather than the initial default that he created decades ago. Otherwise, the oversold is still the below 30. That's the default they created decades ago. We're still using that as our entry. And of course, the exit is when the close is greater than the prior day's high.